Hi, good evening, everyone. Welcome once again to a webinar by Driven to Learn. This is part of the Learn from the Pro series of educational webinars and articles. So tonight we are very delighted to have with us Leng to talk about value investing, as well as we will be inviting Team Phillips as well to come in and to have a fireside chat with Leng. So tonight's session will be a very interesting session, and I'm looking very forward to this. So before we start, let me just go through some admin and a bit of information. This series of webinar is part of the Learn from the Pros educational series. And this is where we managed to get industry professionals to share with us articles and webinars on investing and trading. So Leng will be our guest tonight. We will be having BC Low. BC Low will be coming in next month's webinar, and he has already put forth a few articles on technical analysis for investing. So if you have not, take some time to read his article and sign up for his webinar for October. Ivan Ho has also put up some articles as well. Very interesting from a fund investment manager perspective. Ivan is working in a family office. And of course, we had Kong Hao, who did the first and second webinar series on investing. If you missed those webinars, so just feel free to go into CVent, Learn from the Pro website. You can actually view all the webinar on demand. So without further ado, let me just introduce to you the Driven campaign that is the main campaign that we have for this year. So this is a campaign that you have a chance to walk away with a Tesla Model 3 at the end of the year. So allow me to just play a short video on this.
Think you're driven enough to succeed? Win a brand new Tesla Model 3 in just 3 easy steps. Open a CGS-CIMB trading account and start trading your way to awesome prizes. Participants can trade any of our 6 products to earn tickets. The more you trade, the better your chances. Earn as many tickets as possible from July to December to win the latest and greatest from Apple and be eligible for our grand prize, a Tesla Model 3. What's more, we've also lined up a series of webinars throughout the campaign period to help you become a savvier investor. Don't miss out on these free sessions. Register and level up your trading play. Open a CGS-CIMB account and start trading today.
Fantastic. So those who have not opened an account with us, you can just go to the website and then key in your details here. Our friendly colleague will contact you to open an account. And those who are already having an account with CGS-CIMB, you are automatically enrolled in this campaign. So you just need to trade through us, and you will have a chance to win not only the Tesla grand prize at the end of the year, but also monthly draw prizes. We have monthly draw, and you can walk away with Apple prizes ranging from MacBook Air to iPhone. So don't forget to participate actively. Also, those who are logged in tonight with the webinar, you also have a chance to walk away with $50 Takashimaya voucher. So you see there's a lot of vouchers for the take. And allow me to just play a short video on how you can participate and walk away with $50 Takashimaya vouchers.
Want to win $50 Takashimaya vouchers when you learn from our free investing and trading webinars? You can simply register for our webinars, log into the Attendee Hub, go to Community and click Join Game. Stay engaged and see how you rank on the live leaderboard. Answer polls, ask questions, submit feedback, and more. Only 100 winners with the highest scores will win each month. What are you waiting for? Click Join Game now. Terms and conditions apply.
Right, so you can just click on the chat box or Q&A box and explore the website itself. All action will enable you to earn points that helps you to win the $50 Takashimaya voucher. So for example, if you look on the right side of your screen, you should be able to see some chat icon, Q&A icon, and survey icon. So participate actively. use the Q&A icon for tonight's webinar. Any question that you have, just key into the Q&A box there, and then we will come to all the questions later. Tonight, we'll be having a two-part session. The part one is where Leng will do his presentation on investing. And part two is very interesting, where we have Team Phillips to come in to have a fireside chat with Leng. So put your questions in the chat box, in the Q&A box, and then we will look forward to addressing all the questions that you have later. So next, just let me run through the standard disclaimer. So basically, today's presentation is for educational purposes only, and not any advice or incentive to do any investing. So for investing advisors, please consult your licensed advisor or broker. Great. With that done, let me introduce to you tonight's special guest, Mr. Goh Leng. So Leng is a portfolio manager with a value-based investment fund. He is a director of Taqwa Group, a privately held family-owned investment holding company and management company. He is a frequent speaker at investment conferences held by SGX, SMU, The Edge, and etc. Leng graduated with a Bachelor of Science Honours Economics degree from the University College London, UCL. I personally know Leng for quite a few years, and I'm very excited that every time he shared something on value investing or investing as a whole, there's always something to learn from him. So although young, a very incredibly smart person, and I look forward to learning more from him tonight. So without further ado, let me invite Leng to come on board. Leng, please.
Thank you, Nixon, for the introduction. So good evening, everyone. Thank you for actually taking the time on a Wednesday evening to actually attend today's presentation. I hope everyone has actually had their dinner already, or perhaps you guys might even be having your dinner while we're actually having this entire presentation now. And that's the beauty of technology today. You know, it has allowed for things to become so much more efficient. And in some ways, this is actually all due to the entire COVID-19 pandemic. But I'll touch more about this in the later slides. In today's presentation, I'll be talking more about the fundamental shifts that I actually see in the economy today and addressing the question, is value investing dead? So today's presentation, it will be actually on value investing, is value investing dead, and diving deep into the value approach to investing. So for today's presentation, I'll start off with an introduction. I'll be reviewing what has actually happened in the year 2020, and then I'll be talking about the economy 2021 onwards, some of the fundamental shifts that we actually can see happening over the last decade or so. And I'll be sharing with you guys a company case study that really excites me. And lastly, we'll be having a fireside chat with Tim, and you guys have more than enough time to actually have your questions answered during that fireside chat. So a quick introduction about myself. Nixon has pretty much introduced me already. My name is Leng. I'm the portfolio manager of Heritage Global Capital Fund, a long-only value-based fund in Singapore. And I'm also a director at Taqwa Group, which is my family's private family office. And lastly, I graduated from University College of London, majoring in economics. So what has happened in 2020? Other than the obvious fact that we had and are still actually experiencing the entire COVID-19 pandemic, can you guys think, what are some of the other things that have actually resulted from this entire pandemic? Many of you might actually realize, or subconsciously realize it, that your lives have somewhat changed because of the entire pandemic, be it your daily lives or your work lives. Working from home now seems like the norm. This is not to say that offices will be completely abolished, but management will be thinking about how can they streamline jobs, how can they make things more efficient. If your job scope does not require you to come into office so often, why not just work from home? Perhaps overseas work trips will become more redundant now because meetings can be actually done via Zoom. Even say signing of documents is slowly transiting online via software such as DocuSign or Adobe Sign. And on a more personal level, shopping online, be it on Taobao, Lazada, Shopee, etc., is becoming more and more common. And this is especially so for the older generation. This is something that I personally witnessed for myself looking at my parents. Because of the COVID-19 lockdown last year, that during that 2 months, the older generation was essentially forced online to actually find source for groceries and products. All that initial reluctance, maybe because groceries online is not fresh, or perhaps, products from Taobao is of an inferior quality, they were all disproved. So, and after this entire lockdown, I could actually see how my parents, my in-laws, actually continued this habit of shopping online. Hence, from a surface level, these were all the things that was actually happening in 2020. However, what about the economy? What were some of the fundamental shifts that we could actually see happening in the economy and businesses alike? So I believe many of you would actually still remember this news as it's still quite recent, the closing down of Robinsons. Earlier last year in May, Robinsons announced that they'll be closing down their GEM outlet, and come October, they said they'll be formally exiting Singapore after so many years. They'll be closing down their last 2 outlets at Heeren, which is their flagship outlet, and the other one at Raffles City. However, this trend, is not something new. And we have actually been seeing it happen over the last couple of years or so. Think back, the closing down of Metro at Centrepoint. How many of us actually still remembers John Little? Or even the bankruptcy of Toys R Us. These are not small, medium enterprises that we are talking about, but large companies with long histories that is slowly getting phased out. And this is actually quite similar to what we are actually seeing happen in other developed countries, such as in the US and the UK. Likewise, the same can be actually said for the banks. So during the COVID-19 lockdown last year, I was attending the 3 banks' AGMs. And one thing in common that all 3 banks' management discussion was actually talking about was that because of the lockdown, they could see many of their customers going digital. Many of the customers were going online. So because of the fact that many of their customers were actually going online, suddenly the need for physical branches was not needed as much anymore. And the banks were actually rethinking their branch strategy. They were actually rethinking their branch strategy. And after the whole entire COVID lockdown, DBS was actually one of the fastest I saw react to this entire rethinking of their branch strategy. If you actually remember, there was this POSB branch located at about level 4 or level 5 of Takashimaya. That branch is actually no longer there. Along Orchard Road, some other smaller branches have also closed down as well, such as the one outside Marriott. Now, as we see retail malls, slowly dying, banks actually rethinking their physical branch strategy, what does this mean to us as investors? Let's think about it. The supply of retail space is fairly constant. It's not like we'll see Ion, Wisma, Ngee City suddenly closing down or disappearing. Hence, that's why I say that the supply of retail space is fairly constant. However, the demand of retail space will be trending downwards because these larger players would not need so much physical space anymore because, like I said, their customers are going online, their customers are going digital. With this this entire digitalization, it has actually been happening over the last couple of years or so. It's only because of the COVID-19 pandemic that actually accelerated this shift. So with supply of retail space going to be fairly constant and the demand of retail space trending downwards, this means that the fair rental rate will be trending downwards as well. And valuations are just a function of ROE. If your rental rates are trending downwards, this means your ROE, your return on equity of these property landlords, will be trending downwards as well. And this would eventually mean that the fair valuations of these property landlords will have a fundamental shift downwards. So I have actually been extremely bearish on the Singapore property landlords. And it's not just about the Singapore property landlords. The ones in Hong Kong or any other part of the world, I have too been very, very bearish on them. Without naming names, I have actually spoken to some of the owners of retail malls along Orchard Road, and they too shared the same thing with me, that this new fair rental rate is drastically different as compared to pre-COVID. Those days where property landlords were making huge margins by just renting out physical space, that was of the past already. So now I'd like to actually share a quote by Satya Nadella, the CEO of Microsoft. And I find that this, and what he actually said, really captures the idea that I want to be sharing with you guys today about the COVID-19 pandemic. So due to the COVID-19 lockdown, they've actually seen 2 years worth of digital transformation happen in just a span of 2 months. Companies have been adapting themselves to better position themselves in the post-COVID world. And as investors, we should actually be doing the same as well. Like businesses, our investment portfolios only have 2 options. Either they remain constant and become extinct at one point in time, or they adapt and survive in the new world. So with this, we move to the crux of today's topic, which is the fundamental shifts, or some of the fundamental shifts that we can actually see happening in the economy 2021 onwards. Firstly, I believe that having an understanding of some of these major fundamental shifts that we actually see in the economy today to be very crucial. And when I share these fundamental shifts, it may seem very obvious, but we may not have been consciously positioning our portfolios for it. Even before COVID, it's not that I was ignorant of the fact that retail malls are slowly trending downwards, the rise of e-commerce. I myself have been using these e-commerce websites or apps as well. It's not that I was ignorant to it, but somehow our portfolios was not positioned for it. So some fundamental shifts that we actually see today are as such. Firstly, it will be platform shifts. Now, there have been many different platform shifts. In the past, 10 years ago, it was a really big thing, using the BlackBerry phone. To be on the BlackBerry platform using the BlackBerry Messenger, which was exclusive to BlackBerry phone users only. It was a big thing, or perhaps to me, it was actually a very, very big thing back then, 10 years ago. But now that has shifted, we have shifted from the BlackBerry platform to an Android platform or an iOS platform. Another such shift, and which is maybe more prevalent and more well discussed today, will be the shift towards the subscription platform. Companies have actually been shifting their business models to more of a subscription model, otherwise known as the subscription economy. The beauty of the subscription economy is the compounding nature of relationships. You first acquire a customer, then you charge them for the value of the service you're actually providing for. And as long as the customer they find that your product is of value, and they agree on the price you are charging for that product or service, you have this customer for a really, really long time. And this subscription model idea was first started by Salesforce. And it is actually still in its infancy stages. It may have been around for about 20 years, but comparing to other industries, the retail industry, how long the retail industry has been around, 20 years is still considered in its infancy stages. And like the graph I shared in this slide, while you might incur a huge upfront cost to actually acquire a customer, like in this case, it's $90 to acquire one customer in the first month. But as long as the customer finds your service or product to be useful and of value and agrees on the price you're actually charging, they'll continue paying this monthly subscription. And come the 9th month, you essentially just break even. And the subsequent months, the 10th month onwards, that is pure profit. This subscription economy model is otherwise known as the software as a service, otherwise known as the SaaS model, which is actually a term I believe many of you will have been becoming more and more familiar with, especially given how the share prices of these SaaS companies have been skyrocketing last year. So here are some examples of notable companies within the subscription economy. And many of these companies, you might actually be using them on a personal level or even at work. The best example is Netflix. You are constantly paying a monthly amount to stream your favorite shows or movies today. Or even at work or any of your businesses you're actually running, you might be actually using these other SaaS companies such as Twilio, Okta, Zoom, DocuSign, or Fastly. And if you actually look at the share price increases of these companies within the subscription economy, Netflix last year alone went up by 66%, Twilio 227%, Okta 115%, Zoom 400%, DocuSign 194%, and Fastly 300%. You actually see how much attention these companies are actually getting due to the fact that companies are actually adapting to the new world and using these kind of services to survive and improve themselves for the post-COVID world. So some of you might be asking, this fundamental shift, this platform shift towards a subscription economy, is it isolated only to these more unknown companies, smaller companies? And that's not true. Even the most household name, Microsoft, have shifted to the subscription model. And this was way back, in 2011. They actually had a change in strategy because Google released Google Apps, otherwise known as G Suite today. And this was actually targeted at Microsoft's cash cow, their enterprise customers. And Google Siege actually worked. Many companies started shifting over to the Google platform in the cloud rather than dealing with issues of installing and managing Office offline. And in the current workplace, a cloud solution actually allows companies way more variability in their work processes. And that was when Microsoft had to actually change their strategy. So many of you might notice that in the past, in 2011 or even before 2011, when you buy a Microsoft Office, it comes in the form of a CD, and then you install it on your new PC. And you just pay one fixed price, and you can use your Microsoft Office almost forever. Only when you decide to change your computer, that's when you probably say, hey, maybe it's time for me to upgrade my Microsoft Office to a newer version. However, today, Microsoft have rebranded themselves to Office 365, where you either pay a monthly or yearly subscription fee, and your Microsoft Office version will always stay updated. It never comes in a CD-ROM anymore. Hence, you realize that this subscription model is not limited to really new and young companies, but older companies, if you realize, like Microsoft, Adobe, Gillette, have actually too been shifting over towards the subscription model as well. So the second fundamental shift that we have actually seen will be the shift from web-based to app-based. Back in 2010 and even before that, we did most of our entertainment and communication via the web, the browser. Remember, back then we used Mozilla Firefox. We used Firefox to use Friendster, MySpace, and that's the equivalent of the Facebook app today. Most of what we do today was actually conducted via the web browser, whereas now we're actually doing it through the phone, through apps. The third fundamental shift we actually see is the dominance of mobiles. And it's actually a tie-in with my second point on how how we are shifting from web-based to app-based. And imagine, going out today, out of your home without bringing your phone, how handicapped you actually feel. And if you're actually based in China, you'll be feeling way more handicapped. And having been to China very, very often, pre-COVID, I'll be severely handicapped if I just forgot to actually bring my handphone out. Hailing a ride via TT, paying for food via Meituan, communicating with friends via WeChat will all not be possible at all. The fourth shift will be this concept of ownership versus experiencing it. In recent years, I found that the younger generation places more value on experiences as compared to owning something. And this is highly correlated with the sharing and experience economy. Think about it. Why own a car when you can take Grab or Uber? Why stay in a hotel when you could be having try out new experiences in someone else's Airbnb home? Why climb the corporate ladder for a corner office when you can actually be a freelancer and have the freedom of working anywhere around in the world? Why are business class seats exclusive for business travelers? The younger generation today wants to actually experience the business class seat as well. And you actually notice how credit cards, they are changing their strategy, where it's more about collecting air miles to redeem business class seats. It's essentially catering to this entire shift of the experience economy. And the last fundamental shift that really excites me and what I'll be sharing with you guys much later will be the buy now, pay later phenomenon, otherwise known as the BNPL phenomenon. And I'll be elaborating it later in a case study. But it's something that I don't actually see very prevalent in the Singapore economy yet. So what is the buy now, pay later phenomenon? It's a recent trend where consumers are actually buying products first, taking it home without having to pay the full price for it on the first day, and they do not actually incur any interest cost on it. Some of you might actually say, hey, it's like an installment plan that Harvey Norman or Best Denki actually offers. And yes, it is similar. However, the company that I'll be talking about in the later slides, you realize that it's more of a platform where there are multiple merchants on it. And the platform is the one that actually offers this buy now, pay later scheme for all participating merchants on the platform. And if I have to take a guess, what many of you might be thinking now will be that the people shopping on this platform will be a high credit risk. They will probably have already maxed out their credit cards, and hence they're turning to these kind of alternative lending platforms to continue funding their purchases. However, before I talk more about the company that I'm interested in, I wanted to share some statistics on the changing landscape I see in terms of the spending mindset. So debit cards have become more and more popular over the last 2 decades or so. And you can actually see it from the next few charts that I'll be showing to you guys. So from the 2000s onwards, what you can actually see from this is that debit cards have actually been gaining ground and catching up with credit cards. And come 2008, the volume on Visa branded payment cards in the US for debit cards have actually caught up with the credit cards. If you're actually still not convinced, you actually realize how credit cards are actually losing its appeal. So in terms of the credit cards in circulation, as can be seen from the left graph, you'll realize that from 2000s all the way till 2019, the increase in number of credit cards was not much, only 1.43 billion credit cards to 1.89 billion credit cards. That's a 32% increase over a span of 20 years. And on an annualized basis, that's a low single digit growth rate. And can be seen from the right graph, it shows the number of credit cards per person. And from 2009 to 2019, a span of 10 years, you realize that the number of credit cards per person has also been declining from 3.7 credit cards per person to 2.7 credit cards per person. So this is something that I can actually relate to. Having lived in London and moved back to Singapore, I never really understood the concept of spending on a credit card. In London, most of us actually just use a debit card rather than a credit card. And I felt that it was fine. It was just about spending within my own means via debit purchases. Why must I fund it via a credit card? Furthermore, having the idea of having multiple credit cards never really appealed to me, because to me it's such a huge hassle. You have to remember which card you actually use this month, and you have to remember to actually pay for that credit card. Otherwise, you will actually incur interest costs. The only reason why I eventually got myself a credit card was because of the air miles. I wanted to accumulate air miles. And even though I got myself a credit card, I only got myself one credit card, and I didn't get myself multiple credit cards because, like I said, it's a huge hassle. Hence, these charts and these figures were something that I could actually relate to. But back then, coming back from London, I thought that it was just something that I personally felt. But I did not know, it's only when researching much deeper into this industry, this shift in this spending mindset, did I realize that I'm not alone in this shift. Many others, people in my generation or even younger than me, are actually having the same kind of mindset, shifting away from credit cards towards debit cards. So we have to actually understand, why are credit cards losing its appeal? And if you can see from this chart, which shows the average credit card per person by generation, you actually realize that the number of credit cards per person by generation have actually been declining. The baby boomers had about 3.5 credit cards per person. Gen X had about 3.2 credit cards per person. The millennials had about 2.5 credit cards per person. And Gen Z has 1.4 credit cards per person. So a lot of surveys and research has actually been put into this. And the summary of the research papers and the statistics is as such. So many of the younger generation, having seen what their parents went through during the global financial crisis, are actually becoming more wary when it comes to using credit cards. And they have seen the detrimental effects of using too much credit and being too over-levered, or rather being too over-levered. And surveys have actually shown that the youth of age between 18 years to 29 years, only 33% of them actually owns a credit card. But one caveat is, all this research, all this statistics was actually done on the US population, the US market. It might not be applicable to the Singapore market. So having understood, this shift in spending mindset, now we go back to the question of whether people using these buy now, pay later platforms are a high credit risk, or have they actually maxed out their credit cards? And the first time I actually heard about this buy now, pay later phenomenon was actually when my wife shared it with me, that her friends in Australia were using these buy now, pay later platforms to buy stuff. And these things were simple purchases, stuff like undergarments, food, clothing. Maybe the total purchase price amounts to about $50, and they're paying it by installments. My first reaction to her was that, are your friends really that maxed out on their credit cards that they have to use installment plans to buy clothes? Because in Singapore, the only time that we will actually use installment plans is maybe to fund our property purchase or our car purchase. However, it's only upon deeper research, did I realize there's actually a shift in the spending mindset. Furthermore, as we can actually see from this chart on this slide, you realize that the customers are not highly indebted. The customers have not actually maxed out their credit cards. It's actually about a shift in spending mindset. So what you can actually see from this is that they have actually done research to actually show you that the amount of cash these consumers have in their bank account versus their purchase price. On average, 51% of them actually have a 5 times coverage. 21% of them have about 2 to 5 times coverage, and 7% of them have a 1 times coverage. Only 20% of them cannot actually cover their purchases. So that is about 80% of them. 80% of these consumers on these buy now, pay later platforms have more than enough cash in their bank accounts to fund their purchases. But because it's a shift in the spending mindset, they rather pay it via installments rather than just paying it via cash. And upon deeper research, people actually interviewed this 20% who don't actually have enough to cover their purchases, what they actually realize is that majority of these people are actually paid weekly or bi-weekly, so that they know that the inflow of cash they have will actually match the outflow of cash they have. So these 20% is actually not that much of a risk as well. And therefore, you realize that the initial thinking that consumers on these buy now, pay later platforms are not actually a high credit risk, and this is actually just a misconception. So the company that I would like to share with you guys and that I'm really excited about is this company called Afterpay. Full disclosure, I am personally invested in this company as well, and it's actually listed in Australia. Afterpay is the #1 player in the buy now, pay later industry in Australia, and some of the biggest brands have actually gone under them, such as JD, Ray-Ban, Reformation, ASOS, Lululemon, etc. And Afterpay have become such a household name that people actually use it as a verb. And you go out with friends, you ask your friend, why don't you just Afterpay this? So the revenue model of Afterpay is as such. When you actually use Afterpay to purchase your items, you need only pay the initial 25% payment, like a down payment of 25%. The remaining 75% is split over the next 6 weeks. During the T+2 week, you pay 25%. T+4 weeks, you pay another 25%. And the remaining 25% is paid upon T+6 weeks. There is no interest charge whatsoever if you do not actually meet the payment deadline. So if you think about it, credit cards, the way the credit cards actually makes money is actually by you defaulting on your payments, and that's when they charge you very, very exorbitant interest rates. But this is not the case for Afterpay's revenue model. Afterpay actually charges, they earn their money from the merchants by charging them about 3 to 6% commissions, depending on whether they are larger customers, larger merchants, or smaller merchants. They do not actually charge interest if you do not pay up on time. All they actually charge you is one fixed fee, a late payment fee, and the service terminates itself when you do not actually meet your payment deadline, but there is no interest charge whatsoever. And like I mentioned earlier, Afterpay is becoming like a household name, and people is actually using it as a verb to back it up with numbers to show you how much customer love there is for Afterpay. You can actually see it from this slide, which shows the net promoter score of different digital payment solutions. And Afterpay is actually ranked #1 at 53.6. They are actually ranked even higher than Apple Pay, PayPal, Google Pay, Samsung Pay. Hence, we can actually tell from this that, Afterpay is a highly loved product. Continuing on to actually show you how much customer love there is, you actually see it on the right-hand side of this graph. It actually shows you how much customers actually love Afterpay, where 86% of their orders today is actually from repeated customers. And Afterpay is always engaging with their consumers, asking them, what is the next merchant would you actually like to see on our platform? And Afterpay has actually shared, that consumers love Afterpay so much that when they realize that they are actually unable to meet their payment deadlines, they will actively call Afterpay up to inform Afterpay and say, hey, I'll be missing this payment deadline. Can we talk? Can we negotiate some terms that allows me to continue using the service, but give me an extension in the payment deadline? And, it allows Afterpay to actually jump ahead of the risk curve and manage this risk. And if you actually see in terms of the default rate, it has actually been trending downwards. In 2018, the default rate was about 1.5%, and come 2020, the default rate is about 0.85%. And in this kind of you may say that Afterpay is like lending money, and in the lending money business, naturally there will be some defaults, and a 0.85% default rate is honestly speaking really low. If you compare it to our 3 Singapore local banks, OCBC, UOB, DBS, the non-performing loans is also about 1.5% to 1.6%, which is actually higher than Afterpay's default rate. Therefore, I would say, that the numbers actually substantiate the logic that there is actually a shift in the industry, that people are shifting from credit cards to debit cards, and they're actually not a high-risk consumer base. Lastly, it will be on valuations. If we have to actually look at current valuations of Afterpay, it definitely has risen quite significantly, especially in 2020. However, I do believe that valuations are actually justified because of the current growth rates that Afterpay is actually enjoying. Afterpay, year-on-year basis, is growing at about 110%, if I remember the numbers correctly, but is above 100% revenue growth rates. And what Afterpay is trying to do now is replicate its model in Australia into the US. And the key will be the expansion into the US. Looking at different metrics, be it customer frequency, monthly underlying sales, active customers, active merchants, you actually notice that the US market is actually showing better numbers than what Afterpay was actually having in Australia during the same time period. Furthermore, the US e-commerce market is 10 times bigger than Australia plus New Zealand combined, and the population is in US is also 10 times that of Australia and New Zealand combined. Hence, that's why I say the key is really dependent on its growth into the US market. And I do believe there is further upside from here on for Afterpay. So before I end today's presentation, it's about addressing the question on, is value investing dead? So I find that value investing, it really depends on what is value investing. I don't like to give, all these different terms a certain thinking, value investing, growth investing. There's no difference. To me, it's dependent on how you actually define value. To my grandfather, the banking industry, the property industry, that is of value in the past, during his time. But in today's time, value has shifted. The value is slowly shifting towards these new fundamental shifts, your e-commerce, your digital wallets. Hence, I don't really think that value investing is dead. It's just dependent on how we actually define value. To end off today's presentation, I do blog quite a bit my thoughts, my experiences in the financial markets. If you guys are actually interested to check out more of my writings, you can actually check out my blog at www.investingnook.com. But otherwise, I've come to the end of my presentation, and I'll hand over the time to Nixon, and we can start the fireside chat. Thank you.
Right. Thank you, Leng. Thank you a lot for your sharing. Let me just share my slides. Hi, everyone. So before we go ahead to the fireside chat, could I just give a reminder for you to do your survey? We really will appreciate if you can do the survey on the platform. This allows us to ask questions about how we are doing so that we can continue to provide you with education, and as well as area that we can improve, and also areas that we know that we are doing well. Also, besides that, of course, when you do a survey, you actually have more chances to win your $50 Takashimaya voucher. So really just click on the survey icon and do a quick survey for us, and participate in the $50 Takashimaya voucher draw. So next, we will move on to the fireside chat, and for that, I would like to invite Tim Phillips. Tim is a head of content and investment lead at Prosperous by CGS-CIMB. He has more than 10 years of content experience in financial industry, including things like Schroders and Motley Fool. Some of you might have seen articles written by him and Motley Fool. And Tim believes that successful long-term investing is within everyone's reach. So Without further ado, I'd like to invite Tim to come on board and together with Leng to start the fireside chat, please. So, Tim.
Hi everyone. Thanks, Nixon, for the introduction. Thanks, Leng, for the talk. That was really interesting. I think a lot of interesting points that we can touch on there. I was really interested by the buy now, pay later model. I think it's always, it's always interesting to see an emerging sort of business model come out, especially in fintech. But when I invest, like personally, when I invest in a company, even though I like it, or if I like it, I always like to say, what do I hate about this company, or what do I not like about this company, and what are the potential risks to this company? So we heard the positives and the potential upside, which is amazing. But do you think, out of the risks, there is obviously regulation involved in there? Do you think that could maybe cap its growth? I mean, what do you see as being the main risk for Afterpay or in that industry as a whole?
I guess the real risk for Afterpay, and the founder himself have constantly actually been talking about in public settings. It's when your let's say, for example, your central banks or the government actually start clamping down and say that Afterpay, you are more like a money lender. Essentially, you're lending money to people to finance their purchases, and you have to actually be regulated like banks. That is obviously the biggest risk. And that's the reason why Afterpay have actually been managing this risk quite actively. And that's one of the reasons why they have never wanted to charge interest rates, because they said that if we do not actually charge interest rates, essentially, how are we like a bank? If we are a bank, it's about collecting deposits, lending this money out, and making money via interest payments. But that's not the revenue model of Afterpay. It's just that so happened Afterpay's business model, Afterpay's business model is about buy now, pay later. And in that process, it actually lends money out in a certain manner. That to me is really the biggest risk. But when investing, or that you always will have this kind of risk. And to me, that risk is well managed by the founder himself. Today, Afterpay has actually been acquired by Square. And to me, that's great. It's going to be another function, another service on the Square platform to the entire Square consumer base. So I do think that they actively do know about this regulatory risk, and they will actually manage it quite well.
Yeah, no, that's yeah, I saw that deal. It was a big one, right? 29 billion. So I think they got bought out at a decent premium. In terms of the actual model itself, do you think because these types of companies are getting acquired like Afterpay and becoming part of a bigger ecosystem, do you think the standalone BNPL companies can be as successful as maybe like a Square or a PayPal? Or do you think that the focus is a bit narrow for them to get to that size? Or do you think they're ripe for being sort of a takeover target?
So end of the day, I find that the payments industry is quite commoditized. It's not a winner-take-all kind of industry. And for the longest period of time, we can actually see it in effect. You have Visa, you have MasterCard, and both actually do coexist quite well together. So I don't think that, just because Afterpay got bought out, they joined a bigger ecosystem, that's detrimental to other buy now, pay later platforms like Klarna, Affirm, etc. I think there can be a case for them to still survive. End of the day, these buy now, pay later platforms, they are not entirely similar to one another. While it's about buy now, pay later, but they like to focus on different industries. For example, Afterpay focuses more on the fashion and beauty industry. Klarna, Affirm focuses on other industries as well. Not so much on the fashion and beauty, maybe on cars, on household products and all that kind of stuff. So they are targeting different industries, although they are still within the buy now, pay later industry. So I do think there can be a case to be said that they actually still survive. And I mean, Amazon is actually partnering up with some of these buy now, pay later platforms as well. While Amazon is not buying them out, but they are still getting partnered. So there can be a case that these other players do still survive.
Yeah, no, that's a good point. I think for value investing as a whole, I mean, I agree with you. I think it is mainly dependent on how you view value. I was reading an interesting letter from Howard Marks earlier this year, where he was talking to his son about Andrew Marks. And so he talked about, you know, his philosophy. Andrew is the son, is more sort of growth oriented investor, and then obviously Howard Marks is a bit more traditional, you know, value investor, getting in at a good price and getting out at a good price. Do you think that whole like reversion to a mean concept is like no longer applicable? Because I mean, from Andrew Marx's perspective, it's a lot more advisable to stay with a compounder and just let that compounder ride, rather than trying to time, you know, getting in and out of multiple sort of winners, right? Trying to get in at a good price and then get out at a good price. The odds of you being right every time, as he said, is it becomes a lot lower, right? So do you think that's the new style of investing that we should be sticking to, is just getting into those compounders and just letting them run?
I really think it's dependent on what you believe in. You know, the idea of buying $1 for 50 cents, what you talk about mean reversion, is more of the Graham style of investments. Your traditional, the first old plain vanilla value investing. Then Buffett came along, he took it one notch higher. And I don't think Buffett was ever about, I mean, the earlier years of Buffett was about buying $1 for 50 cents, but slowly through Munger's influence, to Fisher's influence, it started about buying quality companies, you know, allowing them to continue growing, compounding in debt, in your words. But today's term, we're just taking it one notch further, that yes, we want to invest into quality companies, but of course, we want them to be growing much faster. You know, the kind of companies that we are looking at are maybe growing at 80 to 100% revenue growth rates. Bottom line, probably still loss-making. Very different from what Buffett invested in, but it's still in some ways a compounding company. You know, you want to be invested in the long term.
Yeah, that's true. Okay, so I think we are going to take some questions from our Q&A. So we've got some interesting ones. I'll do it first. I'll do the first one. So this person says, value investing is Warren Buffett's time. So now it's Cathie Woods' time. It's all growth investing. Do you agree?
I mean, Cathie Woods definitely got really famous last year. Her ARK funds were invested in all these disruptor companies. But I don't think it's no longer Warren Buffett's time. We do see Berkshire Hathaway slowly shifting towards investing in these kind of SaaS companies. I mean, they invested into Snowflake. It's a great company. So I don't really think that it's anyone's time. It's just that so happened Cathie Woods just got really famous last year.
Yeah. So what are some of the examples of value investing? That's one of the questions. What do you find? How do you think about value? Do you think of it as finding a company that is got a competitive moat, that is, you know, how do you define it? Obviously it's not just based on ratios. I think that's out of, it's a bit of an anachronistic way of thinking about it, but how do you look at value? I mean, what do you consider value?
To me, what I define as value is what is applicable in today's terms. You know, what do consumers actually love today? Consumers today love e-commerce platforms. They like how you gamify the entire e-commerce experience. It's no longer just about going online buying, but there's a gamification element to it. And that's the reason why Shopee became so popular. I mean, there are a lot of other examples. You know, for example, there's this company that we're invested in. It's called Evolution Gaming. It's listed in Europe. But they're essentially, you know, instead of just playing casino games in a casino, a physical casino, they're introducing different elements to it, because now you can, because of the rise of mobile phones, you can play it via the mobile phones. It's not just about playing blackjack or big small, or I don't know what other games there are, but you can play other, you can check them out. But they have actually introduced a lot of other games that you can actually be betting on, having the whole excitement there. You can be, they tried to actually incorporate roulette with Monopoly. And so that's where things are shifting towards, that people actually enjoy these kind of experiences. Not to say that people don't enjoy the traditional experiences, but times are shifting. People, attention span is getting shorter. It's all about how fast can I actually capture the user's attention.
Yeah, no, definitely. Okay, so referring to your bearish view on property landlords, what's your take on the recent CapitaLand investment listing? They've done quite well. So what are your thoughts on them? I mean, they've only been listed for about 2-3 days, but what is your take on that? And I guess a follow up from me is, do you think commercial real estate is going the same way as retail in terms of the users going down and it's structurally changed forever?
I have not actually looked at the new listing from CapitaLand, so I can't really comment on it. But to your question on whether commercials REITs are going to be trending downwards as compared to maybe retail REITs, definitely commercial REITs will probably hold up much better. Office REITs and all that will hold up much better as compared to your retail REITs. But there are certain shifts. Slowly, like I said, offices are not going to be abolished. It's not like we don't need to go into offices anymore. Eventually, we still have to go back to offices. But management will start rethinking on job scopes, like job scopes that do not require to come in so often. Perhaps I just give you a hot desk. You can work from home most of the time, but time to time, when you are actually needed to come in, then do you actually come in? But of course, there are certain job scopes that really requires you to come in, like in the banking sector, when you have to execute trades. These because they are more sensitive in nature, you still have to come into the office to actually do these kind of job scopes. So I do think that commercial space is more resilient. It's more stable as compared to the retail space. Yeah.
Okay, so when you think about the less well-known growth companies, or I guess lesser well-known, is more like Okta, Twilio, DocuSign that you mentioned. Are they likely to grow faster than the established bigger giants like Netflix and Zoom? And hence, do you think there's higher capital gains potential from those types of companies?
So while they may be smaller, they may be growing faster, but this growth rate has actually slowly been trending downwards as well. And you can't just think about it in terms of, smaller companies will be growing faster, while bigger companies, because they're more established, will be growing slower. End of the day, you have to actually assign a probability to them as well. 100% probability for Amazon growing at 40% versus, let's say, a 5% probability that Twilio continues growing at 100%. I rather take the 100% probability that Amazon is going to grow at 40% every single year. So we still have to ask ourselves this probability. What do we think the chances are for this small company to continue growing this revenue growth rate of 100%? Yeah.
Okay, so there's another question on the BNPL sector. Is there a US version of Afterpay already?
There are, like I said, there's Affirm, which just recently got listed. It's backed by GIC, I believe. There are a few other players, maybe like Klarna. So this space, there are quite a few names out there. But Afterpay, from the investor presentations and all that, they have actually said that even in the US market, compared to their competitors, which they cannot actually name, they are still the number one.
Yeah. Okay, so a bit of a question on technical analysis. Do you use technical analysis to enter and exit your investments? And if so,
no.
Sorry, go on. Yeah, no, that was it.
I don't actually use technical analysis. To me, there's no real point. If I really like the business and I think that the valuations is a fair price to pay, I'm happy to just buy it now. if tomorrow the share price drops, I'll be sad, but I'll just continue buying more if there's enough cash in the war chest. But I don't really bother about timing the markets, selling when it's high, buying back when it's low. I know certain people who actually like to do it, but to me, that's not my main focus. To me, my main focus is still about uncovering good businesses, good management, and at decent valuations.
Yeah, no, I totally agree. I would find it too stressful to kind of like try to time it. It just seems like a really stressful endeavor. Okay, so another question on valuations. I think we've got one on the global markets are breaking new highs. So do you still see upside in the next like 5 to 10 years, in this current market?
My family, we are still fully invested. And the only reason why we are still fully invested is because we still do find good companies out there traded at decent valuations that we believe there's still there's growth for it to continue running. That's the reason why we are still invested. So to answer your question, yes, I do think that there are stocks out there which definitely are still of decent valuations and there's still upside potentials. Of course, I do understand things are getting a bit expensive, valuations do get lofty and all that kind of stuff. But it's not to say that there is no companies to buy already. The market is quite big. So we still are able to actually find companies to invest in.
Yeah. Okay, we've got one on your traditional old economy names. So property and bank stocks are here for the long term, according to this question. Should they be safe? Are they safe?
Yeah, I mean, banks are definitely safe. If we actually understand the business model of banks, I think banks in the long run, you can't go too wrong. But that said, I'm only talking about the Singapore banks. So do hear this part, it's the Singapore banks. I'm not talking about regional banks and all that. I can't comment too much on regional banks, but I do believe that our Singapore banking system is pretty robust. The central bank, our Singapore government has put many measures in place to ensure that our financial landscape is very, very robust. So I'm not too worried. Valuations for our banks now are quite fairly decent. DBS is a bit more expensive, but long-term speaking, I don't think you do too badly, but it's really dependent on what kind of returns you're actually looking for. If you're looking at maybe 5%, 8% returns, sure, go ahead and buy the Singapore banks today. But if you are looking for something more than that, I don't think the Singapore market or the Singapore banks would be able to actually offer you that kind of capital returns.
Yeah, no, definitely. Okay, so we've got one on China. So I don't know if you're comfortable answering this, but I think is value investing applicable for the China stocks, or are there some reservations here due to national policies?
I think if it's the China topic, we will definitely need way more time than this to really go dive deep down, my thoughts on the Chinese government's policies and all that kind of stuff. But long story short, my family, we are actually still buying the Chinese names, the ones that are beaten down, names like Alibaba, Tencent. We are actually still buying these companies. We are actually still bullish on the bigger names, not so much the smaller tech names, but the bigger tech names. We are still bullish on them in the longer term. There will be more volatility, but volatility is a two-way street. Some people call when things are going up, they don't call that volatile. But only when things start going down, to them that's volatile and that's a bad thing. So to me, you need these kind of opportunities to actually make money. So long story short, I'm still bullish on the entire China growth story. We are still buying the larger, bigger tech names in China. Yeah.
Okay, that's interesting because I'm quite the opposite. I have I'm from Hong Kong and I've always invested in the market, so I'm quite familiar with the Tencent, the big tech guys, and I was super bullish previously. But I think for me, this has been a bit more of maybe a watershed moment, just because it's kind of shown the government has always been a bit standoffish and kind of let the tech companies do what they want. And you've always had that risk of investing in, you know, a communist country, a Chinese, you know, it's an emerging market, but it's not ruled really by, you know, 100% market mechanism. So you definitely have more state intervention that's been noticeable over the past couple of years. So for me, it seems like maybe the opportunity set is probably going to be better in the sort of mid cap space, mid to large cap space of tech, where competition's opened up, because it seems like margins are probably going to fall in, you know, like the Tencent, Baba areas, just because they own however much of that market that they own. So for example, you know, I mean, Tencent has, or whatever, Tencent and Baba together have, you know, I think like 90% of the e-wallet like business in China, right? So if things get opened up to each other's platforms, do you kind of worry about that eroding margins over the long term if they're kind of capped, or if their growth is capped?
So this thing about the walled gardens coming down is, to be honest, it's not really a big problem, because even when, before, you know, the China crackdown, before China started saying that you guys have to start removing these walls, there have been loopholes, you know, on the Taobao platform. I personally have tried it out, whereby although they may ban terms like Weixin, WeChat, what's the ID, and all that kind of stuff, but stores have found interesting ways to go around this restriction, to actually share their WeChat ID for people to actually add and communicate with them via WeChat. Likewise, on the WeChat platform, you can copy a Taobao link and put it there, and it doesn't link it directly to the app. But people have actually found ways to still be able to link it to Taobao. So this, I know a lot of people are thinking that, hey, you know, when the walled gardens are coming down, Alibaba might benefit a lot to gain the traffic, the traffic that WeChat have been holding so tightly. But to be honest, you know, you will learn to find ways around it, and you just get used to it. So to be honest, even after the walls actually do come down, you won't actually see a huge spike in like, or users using Taobao or anything of that sort. So I'm not too worried about that. And if you think about it, you know, is my conversations with a lot of my Chinese friends, my Chinese counterparts, and one thing I realize is that with these new regulations, yes, you know, things are very, it seems very draconian now. It's very aggressive. But the thing is this, it's also hindering a lot of innovation now. A lot of startups is actually finding it much harder doing business in China now. And in some ways, how I see it is that we'll start seeing a consolidation in the tech space. And that just means that the bigger players will become even bigger, and the smaller players find it even harder to actually survive with all these regulatory clampdowns and restrictions. And that's the reason why I say I'm much more bullish on the bigger tech names in China as compared to your small mid-cap names.
Okay, cool. Okay, so for the digitalization companies like Zoom, are they just the hot flavor of the year, or, you know, do they have legs in terms of the trend?
Like I said, you know, if we think back about these fundamental shifts, we can actually see them happening from 2010 compared to 2020. There has been shifts. 2010, we were probably still using web browsers, you know, communicating with friends. Well, I was still communicating with my friend via MSN. I don't know about you guys, but we were still doing a lot of what we are doing today via the web. But 10 years later, you know, these shifts have actually happened. And you think about it, you know, would you want to go back to the old days where we use VCR, where we have to tape our shows if we go for a meeting, and then fast forward it to the point when we actually want to watch that show we are actually watching? No one wants to move backwards. No one wants to go back to those days of VCR, DVDs, CDs, when you can easily just stream your show on Netflix, on any platform you are using, whether it's the TV or your mobile phone. Even if you're on the way to work, you can actually continue watching your show. And when you have to stop, you just stop, and it remembers where you actually stopped. Why go back to the old days? No one wants to move backwards. And to me, that's why these shifts, you know, these adoption curves, you can't stop it. You can't stop it. It will just keep happening. Yeah.
Yeah, no, you can't. That's true. I like to think that we just need to, you need to change, right? Because otherwise you don't innovate, you just die. So I think in this kind of environment, it's survival of the fittest with businesses that aren't willing to change, right? Or to digitize. Okay, so what are the long-term implications of value versus growth investing with regards to returns?
So I mean, I've not really looked into this as to how the differentiation in returns will actually happen. But just speaking from my personal experience, if you continue investing in these, what you call value companies, I don't think returns is going to be fantastic. You know, the business itself is in a structural decline, and year on year, you might not actually see it. But COVID really accelerated this shift, that you could actually see what was going to happen, what's the fate of these retail malls and property landlords maybe 5 years down the road. So I'm quite bearish on it. And I do believe that in the long run, you will definitely see a differential in terms of growth investing versus value investing. But as to how much this differential will be, I can't say for sure. Yeah.
Yeah. Okay, another one on BNPL. So those types of stocks have soared recently, especially after Square acquired Afterpay, and then Amazon's tied with Affirm. So how much more upside is left?
To me, so honestly speaking, you know, while Square's acquisition of Afterpay of 29 billion was huge, I know you did say that it was quite a good valuation. To me, as a Afterpay shareholder, I don't actually think that that valuation was a fair price. I think that it actually undervalued Afterpay. I mean, my own internal calculations for Afterpay was much higher. I was expecting a 5-year.
I'm a Square shareholder.
But then again, I'm a Square shareholder as well. So I'm fighting both camps. Like, yeah. So to me, overall, it's a good deal. You know, after Square buys Afterpay, I think it makes Square more complete in terms of its offering. As to where these share price will be, honestly speaking, is really hard to say. And to me, investing in these kind of growth companies, I like to have this. I do think about optionality. You know, what kind of optionalities does this company offer me? I don't want to be invested in a company that, you know, it's a property landlord, that's it. There's not much optionality there. As compared to, you know, investing Afterpay, investing in Square, it opens up the whole amount of optionality. And I want to be invested in these kind of companies. To just share another example, let's say C Limited. I think C Limited, you can do all the valuations you want to do, but suddenly they innovate, they come out with a new product. Your valuations, whatever you did in the past, all your models, just is not applicable anymore. It's like if you valued Amazon before AWS, you said, oh, maybe, you know, it's run its course, valuations is fair, I should be selling Amazon. And suddenly Amazon comes out with AWS. Whatever models you did in the past, it's useless. So to me, investing in companies with these kind of optionalities, how do you really value the optionality? How do you assign a value to optionality? So to me, I rather hold them for the long term, that because the management itself has proven themselves to shown the ability to innovate, to keep giving us shareholders these kind of optionalities. So I rather hold it for the long term.
Yeah, no, that's a good point about optionality. I think that definitely, you know, puts paid to the traditional sort of valuation metrics that you would associate with value, right? So it definitely sort of rips up the old like manual. So I mean, if you think about sort of the business models of Atom and Hula in Singapore, are they similar to Afterpay?
They are actually quite similar. I don't think they're actually listed. They're still private companies. But like I said, this buy now, pay later phenomenon, I don't actually see it that prevalent in Singapore. I've asked my Singaporean friends, would you want to use this buy now, pay later? To them, they're like, why bother? And sometimes, habits are hard to change. It takes about 31 days for a habit to actually form. So that initial hurdle is quite hard. I don't think these companies like Hula, Atom, and all that are doing aggressive marketing or doing enough marketing to actually push people, the consumer base in Singapore, to overcome this first hurdle. That's my take on it.
You think it's a cultural thing as well? Because I mean, I feel like in Asia we have this aversion to debt because we've had that experience with like the crisis in '97, and ever since then it's been much more, on the consumer side, that maybe the debt levels are not as high in Asia, whereas in the US, like I think everyone's quite used to taking on debt, or they're quite comfortable with it. And then obviously in the UK and then Australia, people don't have that inbuilt anxiety about taking on debt.
Yeah, it could be. I mean, when I shared Afterpay with my Singaporean friends, the first comment I got was, it's a high credit risk they actually see. I'm like, no, you need to understand the shift in spending mindsets. I showed them the statistics and all that kind of stuff. But I mean, I was like them. When my wife told me about her friends in Australia, I had the exact same thinking. I'm like, I have friends so maxed out that they have to borrow money to buy like clothes, like simple clothes, like $50 and all that kind of stuff. But yeah, I mean, I can understand why there's this huge aversion and all that kind of stuff.
Yeah. Okay, I think we're coming to the end. We've kind of wrapped up with the Q&A. So thanks for your time, Leng. I'll pass it on to Nixon now.
Sure, thank you.
Right.
Guys.
Fantastic. Well, that was a fantastic session. Thanks a lot, Leng and team, for the session. Definitely lots of valuable lessons over there. But unfortunately, we are running out of time, so we probably have to start closing the session. So once again, thanks, Leng and team, for the fantastic session. And before we end, allow me to just do a quick reminder. Don't forget to do your survey. It will really help us to understand your needs and also provide you with better educational webinars and articles in the future. And as well as, of course, it allows you to increase your chances of winning that $50 Takashima voucher. So go ahead and do the survey. And while doing that, allow me to just share my screen again to talk to you about the other webinars that we have. So like I said, this webinar is part of a series of Learn from the Pros webinar. And I'd just like to remind you guys that we have one more webinar to go in this series. It's series webinar number 4, technical analysis for the investors. So that's occurring on 27 October next month. So we really like you guys to register for the webinar and learn from a very, very veteran and experienced technical analyst, BC Low. And this is the website if you didn't get it earlier to register for the Driven to Learn campaign, and do follow us on our social media as well. So with that, once again, I'd like to thank everyone for your participation. It was a great session, and I hope everyone have a good evening and a good week ahead. So thanks and goodbye, everyone.
Thank you. Bye.
Thank you.
Bye-bye.
Bye.